Welcome to your daily Bitcoin briefing deep dive for Tuesday, March 3rd, 2026.
Glad to be here. We definitely have a lot to get through today.
Yeah, if you've been watching the screens over the last 24 hours, you already know we have just a massive amount of ground to cover.
Absolute whiplash.
Exactly. So we are looking at a phenomenon that the data is explicitly calling institutional decoupling.
Right.
Let's unpack this. We've got a dramatic reversal from the weekend's geopolitical slide, a staggering $458 million institutional inflow on Monday alone.
Which is just wild to see in real time.
It really is. Plus, we've got sweeping structural changes in the mining industry and a sudden and pretty severe regulatory freeze in Washington.
Yeah, the landscape changed overnight.
So our mission today is to give you the signal through the noise, laying out exactly what the smart money is doing while the rest of the world just reacts to the headlines.
And what's fascinating here is how these, seemingly disparate events are actually moving in lockstep. The macro geopolitical theater, the internal plumbing of the ETF complex, and the fundamental shifts in how Bitcoin is physically mined, they are all pointing toward the exact same conclusion.
A real-time stress test.
Exactly. A real-time stress test of Bitcoin's macroeconomic thesis. The data we have for you today suggests the traditional rules of asset correlation are completely breaking down.
Well, let's jump right into the microstructure and that massive Monday pivot, because the intraday price dynamics have been, they've been absolute whiplash.
To put it mildly.
We went into the weekend dealing with a brutal flash crash, heading towards $63,000.
Right, and that was entirely driven by the breaking news of the assassination of Ayatollah Khamenei.
Yeah, and the immediate closure of the Strait of Hormuz. Everyone expected blood on the streets for the Monday open.
Oh, the sentiment was incredibly bearish.
But then Bitcoin just aggressively reversed course. It reclaimed the $78,000 threshold, and yesterday it hit an intraday peak of $70,042.
That is a nearly 7% recovery from the session lows.
Which is massive.
It is a violent move for an asset of this size.
It eventually encountered some heavy resistance at that 70,000 psychological barrier, naturally, and consolidated around $67,380 this morning.
Yeah, and technically speaking, if you were looking for bullish structural permanence on the charts, we really need to see a daily close above $71,700.
But the speed of that bounce is what really catches your eye.
Absolutely. The underlying mechanics of that recovery are what you really need to pay attention to. What we witnessed was a complete transition of market control.
How so?
Well, over the weekend, we saw a panic-driven retail distribution. Regular investors were selling the news.
Right, getting out of risk assets.
Exactly. But on Monday, that was entirely replaced by incredibly disciplined institutional accumulation. On March 2nd, the U.S. spot Bitcoin ETF complex saw an absolutely staggering $458.2 million in net inflows.
That is wow.
Yeah, and this effectively ends a month of persistent outflows. Fiduciaries and institutional allocators stepped in and bought the dip with both hands.
And the concentration of that capital is incredible, too. BlackRock's IBIT absorbed $263.2 million of that total.
57% of the entire daily inflow.
Right. It is a massive, aggressive reversal from a $32.9 million outflow they saw just 72 hours prior.
The turnaround is stunning.
And Fidelity's FBTC pulled in $95 million. Even the legacy Grayscale Bitcoin Trust, GBTC, which has been bleeding sell-side pressure since early 2025, recorded a rare positive session.
Yeah, that's how you know the bid is strong. Total ETF inflows have now reached $55.3 billion.
Which is just an astronomical figure to reach this quickly.
It really is, and it's also not isolated to just Bitcoin. We saw Ethereum ETFs record $38.7 million in net inflows.
Solana products drew $17.4 million, I think.
Exactly. And XRP funds added roughly $7 million. So this synchronized entry tells us that smart money isn't just hiding in Bitcoin as a defensive play.
They are actively re-engaging the broader digital asset ecosystem as a high beta recovery play.
Yes.
Let's break down that term for a second, because high beta gets thrown around a lot on Wall Street. Essentially, if Bitcoin is the rising tide, these altcoins are the speedboats catching the biggest waves, right?
That is the perfect way to visualize it.
They carry more volatility and risk, but they offer a higher proportional reward when the market turns green.
Right. Institutional allocators are looking at the landscape, calculating the risk, and deciding to deploy capital across the risk curve. They aren't waiting for the geopolitical dust to settle.
No, they are actively prioritizing asset scarcity over immediate military uncertainty.
They are essentially doing the math on the conflict.
And we have to talk about the macro triggers here because the situation with Operation Epic Fury escalated dramatically overnight.
It did.
Early on the morning of March 3rd, the U.S. Embassy in Riyadh, Saudi Arabia, was targeted by 2 Iranian one-way suicide drones.
Bypassing the inner radar perimeters.
Yeah, they managed to bypass the radar and detonated within the compound, causing a massive fire. This immediately triggered the U.S. State Department to issue an emergency citizen services notification.
Ordering departures from over a dozen Middle Eastern countries.
Right. It is an unprecedented diplomatic and logistical paralysis.
We are seeing the theater of operations move from maritime logistics in the Persian Gulf directly to targeting sovereign diplomatic nodes within the Gulf Cooperation Council.
Simultaneously, the kinetic intensity of the conflict is accelerating. Israeli and U.S. strikes have targeted military infrastructure in both Tehran and Beirut.
And current estimates indicate Iranian casualties now exceed 1,500 individuals.
Crucially for the U.S. macro picture, the human toll on the American side has crossed a major threshold. U.S. Central Command confirmed that American personnel killed in action has risen to 6, with an additional 18 seriously wounded with life-threatening injuries.
This follows the recovery of remains from the missile strike in Kuwait.
And President Trump released a statement on March 3rd calling these casualties the ultimate sacrifice, and he outlined that the campaign to ensure Iran never possesses nuclear weapons could last between 4 and 5 weeks, or potentially longer.
This is where we must connect the events on the ground directly to the fiscal reality of the United States.
Right. The economic impact.
Historically, an escalating conflict of this nature triggers a mandatory, massive expansion of the military budget.
We are looking at asymmetrical warfare in its purest economic form.
Exactly. The U.S. military is utilizing multi-million-dollar Tier 1 assets, think Tomahawk missiles and B-2 stealth bombers, to intercept or retaliate against drones that cost less than $20,000 to manufacture.
It's completely disproportionate from a cost perspective.
Funding a high-tech, asymmetrical campaign over 4 to 5 weeks, or longer, forces the U.S. Treasury into a corner. They have to engage in massive debt monetization.
In plain English, they have to print money to fund the cost of the conflict.
Right. And the market is reacting to that exact fiscal reality right now.
The 10-year Treasury yield surged to 4.1%. Meanwhile, energy prices, gas and crude, are up 30% to 3-year highs.
Factory input prices are spiking.
Because of this structural, war-driven inflation, market expectations for a Federal Reserve rate cut have been entirely pushed back from July to September 2026.
And normally, higher yields are a gravitational drag on Bitcoin.
Right. The opportunity cost of holding a non-yielding asset goes up when safe treasuries are paying over 4%.
But Bitcoin is climbing alongside those rising yields.
This is the absolute aha moment of the data today.
It really is. The multi-decade correlation where bonds act as the ultimate safe haven is failing in real time.
The traditional flight to safety hasn't materialized in the bond market?
Because institutional investors realize this conflict is fundamentally inflationary. Bitcoin is breaking its correlation to bonds and acting as the ultimate stagflation-resistant hedge against war-led dollar debasement.
It is a mathematically finite bearer asset with zero counterparty risk.
And that mechanical necessity for the Treasury to print money is exactly why analysts like Arthur Hayes are circulating a $250,000 price target for Bitcoin in 2026.
But hold on, $250,000, we're hovering around $67,000 right now. Is that just Arthur Hayes being provocative for engagement, or does the debt monetization math actually support a leap that massive?
Well, it sounds hyperbolic until you look at the M2 money supply expansion required to fund an open-ended Middle Eastern conflict while simultaneously servicing existing national debt at 4% interest.
Right, the interest payments alone are staggering.
Hayes is calculating the exact point of fiscal dominance, the moment where the central bank has no choice but to let inflation run hot to inflate away the debt.
So the $458 million in ETF inflows yesterday
is simply the very first wave of institutional capital seeking sanctuary from that exact mathematical certainty.
That paradigm shift perfectly sets the stage for what is happening under the hood with the people actually securing the Bitcoin network.
The miners.
Yeah. If the U.S. is printing money and energy costs are surging 30%, miners are getting squeezed. We are witnessing the death of the traditional HODL model for public miners.
It's over. Because of margin compression, legacy miners are completely abandoning the mine and hold strategy.
Overnight, MAR, formerly Marathon, updated its policy to open the door to selling its stockpiled Bitcoin just to manage liquidity.
And Core Scientific went even further. They announced they're selling the bulk of their 2026 Bitcoin holdings to fund an AI pivot toward high-performance computing data centers.
It is a structured collapse of the pure-play mining model for any operator who failed to diversify or optimize for extreme energy efficiency.
But the sheer divergence in the industry right now is incredible. While legacy players are pivoting away to artificial intelligence or liquidating their reserves just to cover operational expenses, you have a pure-play counter-trend emerging.
Right, American Bitcoin Corp.
Yes, ABTC just announced a massive purchase of 11,298 new ASICs.
Wow.
This expands their capacity by 3.05 exahash per second, bringing their total to 28.1 exahash across roughly 89,000 miners.
The efficiency metrics on this new hardware are insane. ABTC's new fleet runs at 13.5 joules per terahash.
And we need to establish why that specific efficiency metric matters to you as an investor. It establishes what we call a thermodynamic floor.
Let's break that down.
Think of it like the cost of pulling physical gold out of the ground. If it costs a mining company $60,000 in heavy machinery, labor, and electricity to mine one Bitcoin, they simply won't sell it for $55,000 unless they're facing imminent bankruptcy.
It puts a hard physical floor under the digital price.
Exactly. The market rarely lingers below the baseline cost of electricity required to mine the asset. What we are seeing is the network hash rate centralizing into highly efficient US-based professional operations.
The rising cost of power is acting as a natural filter, stripping away the weak players and consolidating control.
Precisely.
So Wall Street is buying, the macro environment is forcing dollar debasement, and the mining industry is centralizing into hyper-efficient U.S. operations. You would logically think Washington would be rushing to provide a clear regulatory framework to capture this industry.
You would think so.
But instead, we are seeing a total regulatory enclosure. The Clarity Act, which was supposed to be the landmark digital asset market structure bill, has completely stalled.
Dead in the water.
As of today, it has a near zero chance of advancing through the Senate Banking Committee this month. The negotiations collapsed entirely over the definitions of stablecoin yield.
And the Office of the Comptroller of the Currency, the OCC, just poured gasoline on that legislative fire.
Yeah, they released a 376-page draft of proposed rules for the Genius Act.
This draft explicitly favors the traditional banking sector by proposing a near-total ban on interest-like rewards for passively holding stablecoins.
Meaning, under these rules, issuers and exchanges could not pay you yield simply for holding the token.
Right. They draw a harsh line between holding and using, meaning you might get rewards for verifying merchant transactions, but passive holding is banned.
The entire goal is to prevent massive capital flight away from traditional low-yielding bank deposits.
Absolutely. And this has created a massive rift in the crypto industry itself. Coinbase's CEO is threatening to withdraw support for the bill entirely.
We have to understand why this matters to them. Exchanges like Coinbase use stablecoin reserves, like USDC, to generate treasury yield in the background.
Exactly.
If they can't offer rewards to users to keep that capital on their platform, that money flows back to traditional banks. This ban threatens roughly 20% of Coinbase's corporate revenue.
But on the other side of the aisle, Circle, the actual issuer of USDC, is praising the OCC's report.
Right, because they seem perfectly willing to sacrifice yield products if it means they get federal legitimacy and integration into the banking system.
That internal friction is a massive roadblock. This industry conflict, combined with the relentless lobbying from the traditional banking sector, essentially guarantees that we are stuck with regulation by enforcement for the foreseeable future.
The legal certainty that massive, sideline institutional capital has been waiting for is delayed indefinitely.
Yet, as we saw with the $458 million inflow, the Tier 1 fiduciaries don't care anymore.
They are entirely ignoring the regulatory freeze in Washington.
They are acting on macro necessity, not regulatory clarity. But while the institutions are accumulating, we have to look closely at the internal market plumbing because there are crucial warnings flashing on-chain right now.
The whale movements.
Yes. The all-exchanges whale ratio has surged to a 10-month high.
Which tracks the size of the top 10 inflows to exchanges relative to total inflows.
Right. When it spikes like this, it tells us that massive long-term holders, the whales, are moving huge amounts of Bitcoin out of cold storage and onto centralized exchanges.
Historically, this signals strategic intent to dump. They are likely preparing to use this recent price bounce and the media excitement as their own exit liquidity.
And this is happening while the overall spot trading volume is sitting at a 3-year low.
The mempool, which tracks the backlog of unconfirmed transactions waiting to be processed by miners, is an absolute ghost town right now.
There is very little organic retail demand for block space.
Plus, technical analysts are staring at an unfilled CME gap between $88,500 and $90,000.
Yeah, for anyone unfamiliar, a CME gap happens because the Chicago Mercantile Exchange closes over the weekend, but crypto trades 24/7.
If the price moves wildly over the weekend, a gap appears in the traditional chart when the market opens on Monday.
Market makers naturally drift the price back to fill those missing liquidity books.
So that gap acts as a technical magnet long term, but short term, this market structure is highly vulnerable.
Very vulnerable. A single large sell order from one of these whales could trigger a violent downward correction because the order book liquidity is just so thin.
That is the immediate microstructural risk. However, there's a massive counterbalance we have to factor in here.
The exchange reserves.
Yes, whales are moving coins to exchanges, but the overall spot exchange reserves are at multi-year lows. There are only 2.6 million Bitcoin left across all known exchange wallets.
It is a historic supply constraint.
So we have a fascinating high-stakes tension building. Whales positioning to sell into a thin market, going directly head-to-head against institutional ETFs that are mechanically absorbing hundreds of millions of dollars a day.
And if fiduciaries keep taking $400 million plus off the table every single session, it could completely overwhelm that whale distribution.
If the whales try to dump and the ETFs absorb it all without flinching, it could trigger a massive short squeeze, pushing the asset violently upward through that liquidity trap.
It's the irresistible force meeting the immovable object.
Let's bring this all together for you. We started this deep dive by stating that we are witnessing true institutional decoupling, and every piece of data backs this up entirely.
Down to the letter.
Over the last 24 hours, professional fiduciaries have classified Bitcoin as a necessary stagflation-resistant hedge.
As yields surge above 4% and war-led inflation spikes energy costs by 30%, you are watching the multi-decade safe haven bond trade fail in real time.
Investors are watching that traditional safety net evaporate, and they are actively replacing it with a mathematically finite bearer asset.
They are doing this while completely ignoring the regulatory freeze in Washington.
And they're doing it exactly as legacy miners are forced to liquidate their corporate treasuries and pivot to AI data centers, leaving only the most hyper-efficient American operators to secure the network.
Which brings me to a final lingering thought I really want you to mull over today.
Let's hear it.
We are watching a fundamental rewiring of who owns this network. If Wall Street ETFs are mechanically swallowing hundreds of millions of dollars in physical Bitcoin day after day, and at the exact same time, the only miners surviving are hyper-efficient, massive U.S. corporations.
Hey, big guys.
Right. At what point does Bitcoin stop being a decentralized rebellion against a traditional financial system? If Wall Street corners the spot supply and centralized U.S. mining conglomerates control the hash rate, does this asset eventually just become another heavily regulated, captured instrument sitting entirely on the Federal Reserve's shadow balance sheet?
That is the multi-trillion-dollar question, and it completely changes how we have to look at the next decade of this asset. Thank you for joining us for today's daily briefing. Keep your eyes on the data, stay objective, and as always, keep questioning the consensus. We'll be back tomorrow to unpack whatever the market throws at us next.